it's, something that if you're going to trade stocks, it might be something that's worth taking a look at. So we're going to take trades, and we've been kind of building up to this from module 2 and 3 and 1 and 4. We're going to now start going from a list of stocks from VectorVest all the way down to the option strike price based on everything that we've covered: overpriced, expiration, probability in the money, open interest, all through that, and we're going to get a good list of candidates, and it's really only going to take us a couple seconds. So you'll see how that works today. So today's plan, as always, we'll do a quick review of what we talked about last week in Module 4, just the key principles. I'll introduce 4 new key principles for maximizing your trade setups. I'll wrap it all up with a big mistake to avoid, and as always, I've got some action items for you guys to take for homework so we can have something to work with towards Friday's mastery session. So let's go ahead and kick it in. Module 4, we learned some primary concepts. We learned about the DEW, the DEW. And what the DEW is our market timing signal. The DEW is what tells us, should we go bullish, should we go bearish, or should we do nothing? Now, I've got a couple questions about that we answered in the mastery session. There are times when there is a do nothing. If you're in between signals, we don't do anything. So the DEW tells us to go bullish, bearish, or nothing. We also talked about the scans to use. Now, I said last week, and I said in the mastery session, that I personally do not use any other scans to find my trades. There's lots of scans in VectorVest, and they're all really good, but these are the ones that I've used over the past, couple of years that I've been here, and they've really given me some very, very good results. So I gave those scans to you. They're in an Options Pro Advantage folder. I also talked about the neutral search that you should have in there as well. That helps us either pick up ADX below 20 if you have ProTrader, or at least some stocks that are in a good range without ProTrader. We talked about how to identify the best patterns with charts. Now that right there, of course, is the artistic side. And the only way you'll get comfortable with that is really to look for charts. To me, I always ask myself at a base, how do you identify good chart patterns? It can really be brought down to 2 questions. If you're in a bullish market, DEW up, and you do a scan for something like, I don't know, long-term winners, or something like, Vector plus Vector 125 with higher highs, and I pull up a graph. If I look at that graph, ask yourself a question: would you want to be long? If the market's just going back, or the stock's just going back and forth and not really making new highs, you don't want to be long, it's not a good stock to trade. On the reverse, if the DEW is down and you did something like IG plungers or gravity, and you look at that stock and it's just kind of going sideways, ask yourself, if I was short this stock, would I be happy? If the answer is yes, that's the first level. That's the base level of being able to read a chart pattern. Okay, it takes a little bit of time, it takes a little bit of practice, and it really just takes looking at graphs and charts. We talked about earnings and dividend landmines. We do not want to place a trade if earnings are less than 14 days away. It just doesn't give us enough time to take profits and have room for mitigation if the trade goes against us. So I establish a 14-day rule, and that's calendar days. I will not place a new credit spread if earnings are less than 14 days away. We also talked about dividends. Dividends to me are not a huge concern. When I put trades on, I very rarely look to see where dividends are coming. If I'm in a trade and I have to mitigate the trade, which we'll talk about more next week in Module 6, when I start doing mitigation, I start looking at dividend dates. Okay, the trade's getting closer to my short strike. Is a dividend risk here? Now, the dividends are only for call spreads. They're not something that has to be worried about for put spreads. And then we also last week showed indexes and ETFs. And I've mentioned this before, but the majority of the money that I make trading comes from indexes. That doesn't mean I don't trade stocks. I don't know, let me look at my brokerage account right now. I have an index trade on, but I also have 1, 2, 3, 4, 5, 6. Okay, that one's actually, I got out of profits on that one today. 1, 2, 3, 4, 5, 6. I have 7 trades on 1 is the SPX, and 6 are stock trades. So I don't not trade stocks, but I put more money behind the indexes, and that's where the majority of, of profits come. And at the end, we're going to show you a bonus session on the SPX, and I'll show you how I apply a customized strategy based on what you've learned in the Paycheck course. So that's coming up after all the modules are done. All right, without any further ado, let's kick it off into our Module 5, the Trade Setup Maximizer. And this really, again, is all about maximizing the way you find and also set up your trades, premiums, getting right to the results as fast as you can, things that have good open interest. And this is important because, when you don't want to spend a lot of time going through graph after graph only to find out that the stock you chose doesn't have options that meet our criteria. This was one of the toughest things for me when I first started trading options. I'd find this killer graph. I wanted to place a trade on it. I modeled the trade. And then I go and look at the open interest, and the open interest is not even there. I wasted 15 minutes of analysis looking at something that wasn't even a possibility. Or you don't get paid enough. You see a graph, and the graph looks good, and maybe there's open interest, but there's not enough premium to put the trade on. Now, we're going to talk a little bit more about minimum premiums in Module 6, but this Module 5 kind of builds up to how we can work our scans and our selections to make sure the premium is there before we even look at the graph, okay? So I'll introduce 4 principles to getting paid top dollar. Before we get into the actual selection and maximizing our efficiency and our time, I want to talk a little bit about maximizing the dollars, making sure that you're on the right side of volatility. So you want to ride the volatility slide. What does this mean? When you sell options, you want to make sure that your volatility, that implied volatility, remember that whole overpriced, underpriced thing? You want to make sure that your overpriced options essentially do not get more overpriced. The enemy of a credit or an option seller is rising volatility. And the reason why we show kind of the slide approach here, think about a slide. You want to get on the top, okay? When you do a slide, it's not very fun to try to walk up the slide. You get up on the top, you slide down, you have a good time. So I want to talk a little bit more about this volatility slide and how to really interpret that overpriced options that we introduced in Module 1. Remember this guy? We talked about this in Module 1. You want to focus on selling expensive things. You want to get juicy premiums. And in order to do that, we've got to look at the volatility. Now, this was the indicator that we introduced to you guys back in Module 1. This is the over and underpriced indicator, and it's your guide to cheap versus expensive option premium, okay? All this indicator is, it's nothing fancy. It is simply the difference between historical volatility and implied. The root of the concept is this. When implied volatility is greater than historic, options tend to be expensive. On the histogram or on the graph that you see down here, let me get out my laser pointer, when the implied volatility is greater than historic, it gets up into this cyan color and it gets up to this area where it's overpriced. If implied volatility falls below historical, it gets down here to where it's in rose color and it's underpaid. Now, what we need to start doing, we need to start analyzing this thing and taking a look and saying, where is volatility most likely to be either stable or decline? And the way that you have to do this, this is again kind of bringing Module 4 back. This is somewhat of an artistic thing. Now, this yellow line that I've drawn on the over and underpriced indicator, this is the last 4 times that options became overpriced on Tesla. We want to focus where we have the least likely chance of options becoming more overpriced. And this is, again, this yellow line is something I added to the screen. Now, again, this is an artistic interpretation here. What I want to make sure, I don't want to take trades. So if you look at where the tops for the 3 out of 4 of these things came in, they became the most overpriced in 3 of the 4 rises in volatility, right about here at probably 20%. Okay? Now, again, it's an artistic thing. So I would be very, very concerned about taking a credit spread when it's about right here. Because if volatility goes up, that's going to hurt my trade. All right? Now, what causes this? This is, by the way, probably one of the most, I'm going to say, dependable, predictable patterns in trading. Do you notice how volatility seems to go up on a quarterly basis? That's because the primary driver of an increase in volatility is an earnings event. Okay? Think about what implied volatility is. Implied volatility is the trader's idea or estimation of what the stock may do in the future. Earnings are the biggest mover of a stock. Normally, when we do a credit spread, we sell a credit spread maybe 1 standard deviation away, okay, at a 16% chance ITM or a 30% ITM chance. Remember back from Module 1? When an earnings announcement comes in, that can drive the stock 2, 3 standard deviations, 4, 5 standard deviations. As earnings come in and as you get closer and closer to the earnings announcement, this is where volatility will start to rise. Now, what typically happens in implied volatility, you're going to get about 3 to 5 weeks before the earning announcement. This is where your volatility is going to start to rise. That's why, for the most part, except for this one back here, okay, you typically will look about 3 to 5 weeks before the earnings announcement, and you'll see a slow, steady rise in volatility. 3 to 5 weeks, slow, steady rise. Now, what we've got to try to do is place our trade properly so we have a low chance of volatility continuing to increase. Okay? So we got to take that kind of stuff in mind. When you sell an option, when volatility rises, an expensive option becomes even more expensive. That's not good. We want to sell overpriced options. Then we have to buy them back at some point in the future. And when I buy that option back to close out my trade, I don't want it to be even more expensive. So we've got to be very, very careful on this. Okay? Now, don't worry and don't get all crazy about how if you're not picked the right time and pick the right volatility, it's going to completely kill you. But I do want to teach you the concept of looking at this indicator and identifying, hey, is volatility stable or is it more likely to rise, okay, based on historic patterns? All right, so let's kind of bring this in here. I want to show you how rising volatility can actually affect your trade. So it's not just a theory. Overpriced options that become more overpriced can hurt your trading. I want to actually show you scenarios of this. So let's look at 4 scenarios of selling a put on Tesla to understand how price and volatility affect the option price. So what we're going to do, we're going to model selling the 180 put on Tesla on May 10th. All right? Why May 10th? Well, because I picked that date, and if you go back to the graph, you know, May 10th was about right here. Maybe we thought the stock was going to go up, whatever. All right? So this model selling the 180 put on Tesla on May 10th. You can kind of see that the prob ITM is only about 13%. You know, we've got some time to expiration. We're probably about, 30 days or so. All right? Now, so let's think about this. Let's do some scenarios. Scenario 1 is this. The stock rises. That's what we want. When we sell a put, we want the stock to rise. Now, what I've done, and I don't use this projection tool a whole heck of a lot in Options Pro, but it's really good for showing you what volatility and the price and how the price moves of a stock can affect your trade. So if the stock rises, and that's what we want when we sell a put or do a bull put spread, we want the stock to rise, go up. Now, what happens if volatility during that stays flat? It's stable. It doesn't go up. It doesn't go down. It just stays stable. Now, I want to show you what this area right here is the projected underlying. You see how it's got this line that's moving from this white dot right there? That's the current day of the trade. Okay, that's May 10th. You can kind of see how it moves slowly up to the upper right. Now, do you see how that little purple envelope or cone is in there? That's like a probability envelope that we talked about in Module 1. So what I did is I simulated what would happen if the stock slowly and gradually over the course of the next probably about 40 days or so made a 1 standard deviation move up from a price of about I can go back and look, from a price to about 207 to 235. Okay, now on this bottom pane, this is the volatility, implied volatility. Well, if you look at this line, this is where the volatility was at when I placed the trade. And what I did with this line is I just kept it flat. Volatility doesn't do anything. All right, so we sold that for basically $3,130. The option was $3.13. Now, I realize that this is a naked put, but I just took out the long call just to show you how this works. We sell a naked put, it's got a $3,130 credit. Where do we take profits? At half of that. So here we go. As volatility stays stable, 8 days later, and that's calendar days, by the way, not trading days, 8 calendar days later, we're sitting at 50% profit. Now, while we're on this graph, let me also show you something else. Do you see how long it took to get to 100% profit? You basically would have had to hold on to that trade for like another 4 weeks, all right? From mid-May till about early June. Another 3-4 weeks to get the remaining profit in there. That's a long time. Remember how I said that we want to get 50% because it's very easy to make that? Well, you made that in 8 trading days. All right, that's the beauty. All right, now let's bring scenario 2 into mind. Scenario 2 is if you take a look at the underlying, I've got the stock just going sideways. It's not going up, it just goes sideways. We thought Tesla was going to go up, we were wrong. So in scenario 2, the stock just stays flat. It doesn't go up or down, but volatility also stayed flat. Well, remember, if we're wrong on the trade and the market just doesn't really go up or down, remember, time decay will come in as a bonus and make this trade work. So if you look at the risk graph, we still hit 50% profits. The only difference is the trade took 15 calendar days to take. Okay, 15 calendar days is, in the trading world, that's like 3 weeks in the trading world almost. That's almost 3 weeks trading. If you count weekends and stuff. That can take a while. So let's take a look at scenario number 3. Now again, volatility staying flat, stock stays flat, you're still making money. So now, here's what I've got. Take a look. I've got the stock going up and making that 1 standard deviation move. Now, I've got volatility starting to rise. As we're into the trade, volatility is now starting to rise, and an overpriced option is becoming even more overpriced. Now, the stock's going up. The stock is going up in your direction. What happens to that trade? You hit profits, but it took you 16 days. 16 days to hit profits because volatility rose. All right? Now, you might look at that and say, who cares, right? 16 days. 16 days basically doubles the length in the trade. All right? It doubles the length. Now, what can happen in 16 days? 8 to 16, we could get some kind of weird news event. We could get weird anything that can happen and can completely drive the market in a different way. We've got to be careful. We want to maximize where we're placing these trades. Now, here is the next scenario I want to show you. take a look. The stock is staying completely flat. It doesn't change in price, right? We thought it was going to go up, but it didn't. It just went completely flat. Volatility is still going to rise. Well, guess what? We still hit profits, but that took us 25 days to hit profits. That's a long time to be in a trade. That is not my goal. Okay? Look at what happened in the first 2 or 3 weeks of that trade. We made nothing. And then finally on time decay, it started coming in there, really when volatility started to peak. But we made money in 25 trading days. Now, again, you're going to look at this and say, well, Ron, those are all 4 profitable trades, but who cares? You want to maximize your money. You want to be in the trade for a short amount of time as possible, because the shorter you're in the trade, the less things can happen. News events, anything. We do not want to be in this trade any longer than we have to be. So think about what we showed you. If the stock rises, okay, if the trade goes in our direction, 8 days, 15 days. If the stock stays flat, 25 and 15. Now that's if volatility rises and if volatility is flat over here. So take a look. If the stock rises and we get volatility correct, we're going to be in that trade for only about 8 days. If we get volatility wrong, it's going to double the amount of time that it takes. Basically the same down here. All right. We want to try to focus on this right here. And at worst case, if we're wrong on direction, we might fall, to down here. But volatility does have a real impact on your trades. Okay. Got to be careful of it. All right. So this is that Tesla graph again. I want you to start focusing your trades where options are the most overpriced and they have the lowest chance to increase volatility. Now, how do you know it has a low chance to increase volatility? Again, this is artistic. All right, you're not going to be perfect every single time. I'm actually going to draw a little pen on here. Take a look at the last 1, 2, 3, 4, 5 times that volatility got high. Except them right here, except for that little last minute push, the volatility kind of reached its peak right along this, okay? Right along this arc. So what I would want to do, I don't want to take trades when volatility's right here. That's too much room. Maybe take a trade when volatility is right here as long as you have 14 calendar days before earnings. Maybe place the trade right here and not so much right here. Maybe back here. And again, I'm looking at the actual graph of over and underpriced. Artistic, but when you start looking at past IV rises, you'll notice that they form a constant pattern. If I'm looking at the trade in Tesla, maybe not so much right here, but I would take it right here. Now, you might look at it and say, well, Ron, volatility shot up big time. Yeah, that was something that doesn't happen very much on Tesla based on the history. Would that have hurt you? Yeah, but the market did go in the direction and it went down. Well, instead of doing a trade here when volatility is overpriced but not overpriced enough, we might want to take it when it gets a little bit closer, like right there. Again, it's artistic, all right? Very, very, very much artistic. So let's do some, analysis. What we don't want to do is take trades when it's underpriced and rising. Not right here when we still have room to get to that base level. Not right here when we still have room to get to that base level. All right? Because sometimes the difference in 7 days can be the difference between a gain and a loss. Okay? It really can. You got to play this as best you can. So let me put up another scenario here. I want to put a case study on this. On April 13th, we did a Tesla bull put. Now, why did I do it on April 13th? Well, the stock was up that day. Options were overpriced. But remember, it wasn't near like these levels up here. We still had a lot of room there. Okay? Overpriced, but, options are below the average highs. I mean, this is where the peak kind of came in. I don't want to be doing the trade here. I want to be doing the trade more up into this area. So let's take a look at what would have happened if we did that trade. This again was back on 4/13. I chose a 235, 225 put. All right, it's 38 days to expiration. Open interest is good. My prob ITM is good, 28%. Everything looks great there. That trade has a $280 credit, $720 maximum risk. Okay, with a $280 credit, our profit target is going to be $140 per contract. That's what we're looking to do, right? 50% of the $280 credit. Now, on that trade, using the projection tool, and again, I don't use the projection tool very often just to show things in hindsight. The most you were ever up was about $38. The market did go up a little bit, okay? It came up a little bit, but the most you were ever up in that trade is about $38. Not enough to really ever take profits, all right? It was a good trade, but the options were not overpriced enough. There was still room for options to become even more overpriced, all right? Now, what if you had waited until volatility was closer to the average highs, all right? Case study number 2, I'm going to look to take this trade about 9 days later on April 22nd. Again, the stock is up that day. We really don't have a resistance level up here about $265 a share. The stock had a lot of room to go. But now look at where options were overpriced, okay? Still had quite a bit of room, all right? And they're more near the average highs. We're going to do the same kind of trade, 237.50 and 227.50. I realize the open interest wasn't exactly high on that, but we're going to do it for, you know, the benefit of hindsight here. ITM 26%, 15%, we're 29 days to expiration. And our credit on that trade, look at the difference in credit, $414. A max risk of $586, okay? The profit target on that's $207 a contract. You're getting more credit. You're getting a ton more credit and a lot less risk. Now, you remember back in Module 1, I said the more overpriced an option is, the less amount of risk that you have. This is a classic example. We're going to be making a lot more money on the trade, and risk-wise, there's a lot less risk. All right? Now, in this particular example, you hit your profit target only a few days later. It made that $218. All right? What happened afterwards? Well, what happened afterwards, 7 days later, that trade was near a full loss, $581. It was a big loss. And the recurring theme of the paycheck concept is to limit market exposure because a lot can happen in that 7 days. Now, I don't want to warn you guys to the point you're afraid of misanalyzing the credits, misanalyzing the, the over and under price. It takes a little bit of time for you to go back there and look at previous rises. Like I said, this is one of the more predictable things in options. When you look at the rise of volatility, it's really, really common, and you see the market rise, or the stock, you see the rise come into a very consistent level over the course of time. And that, that over and underpriced indicator will show you what the history was, how much it rises typically before earnings, and you can start getting a feel of where to place the trades based on that, okay? So what we're ultimately looking for, we're looking for volatility to be more likely to go down or stay stable than going up. I want volatility stable, all right? That's what I want. That's the goal. All right. Now, I'm going to kind of go a little off cuff here, and that's with just IBM. Okay. Take a look at IBM. You can see how earnings really affects how volatility goes. Look at that rise as we get closer and closer to the earnings date. And do you see how it tops like right here? If I'm placing a trade on IBM, and again, remember, this right here is our artistic, all right? We're going to get a rise usually about 3 to 4 weeks before the earnings announcement. And you can kind of see it right here. You can see that it's very, very consistent. What happens after earnings? After earnings, we stay relatively stable. After earnings, we stay relatively stable. You know, one of the things I can tell you is that one of the greatest places to do a lot of credit spreads is right after the earnings announcement. Look at this. Earnings, options are still overpriced, and they really don't move around very much. Now look at this one. Earnings, option underpriced. That's not something that I would want to trade on IBM. Now look at this one. Earnings, options still stayed overpriced. Okay, it ticked up one notch there. But look at how volatility stayed stable all the way through. We still had an area of overpriced. It rose for 1 or 2 days, but for the most part, it stayed very, very consistent over the course of the next 2 months. Look at earnings back here on 4/20. Very, very still overpriced, and volatility dropped or stayed consistent. All right, this is the kind of area that I'm looking for. Now, another thing that I see on IBM, here's the big peaks. Now, if I come in right here on IBM, I got to tell you, I wouldn't mind placing an earnings or placing a trade right here when options are overpriced. I know it can go back up a couple percent, but nothing significant. It's already significantly overpriced. And I still have a good 2-3 weeks before earnings. Now, if I go back to that and look here, well, I only have 4 or 5 days before earnings. I'm not going to do anything there. I'm probably not going to do anything here because I'm too close to the earnings date. There's an artistic side to this that you have to get comfortable with, okay? So kind of keep that in mind. You will get used to it as you start looking at the graph, all right? But there's a lot of times when that overpriced will plateau. I mean, look at this before the earnings announcement run. I could have done credit spreads, bear call trades, really anywhere from, you know, February into about that 5 weeks before the earnings announcement into March. And I could have been successful. I could have placed more bear call spreads after the earnings announcement, really all the way till, you know, even if I got caught a little bit, I could get out of it there. It's an artistic thing. So don't feel bad if you're still not getting it. You got to look at some graphs. It will start to become more comfortable as you can see it. But as a general rule, remember, usually about 3 to 5 weeks before the earnings announcement, that's when you start seeing volatility start to rise. And there may be a period in that 3 or 5 weeks where we start to plateau, and you have to look at the previous peaks to see it, okay? But use, analyze, and interpret that indicator, all right? That's a little bit deeper look into how volatility works. Now, I want to change our maximization concept here, not to maximize volatility, not to maximize premium, but now I want to talk about time efficiency, maximizing how much time you take to look at this stuff. We're going to talk about scanning with the matrix. Instead of doing all the work yourself, looking at the most overpriced options, let a machine do it for you. I accidentally muted my microphone. Sorry about that. There's a movie called The Matrix, right? Keanu Reeves. In it, machines and computers did everything. There's scenes where humans just looked at the computer code and were able to see, you know, what was going on. I want you to do something similar here. We're going to use the matrix in Options Pro to scan options and get to the trades as quick as we can. Now, here's what we've learned so far. We've learned that we can use VectorVest, the Unisearch, to get ourselves a solid list of stock candidates. What we're going to do now is use the matrix to start taking that list of stocks from VectorVest and bringing it down into what we've talked about so far for options trading. So the matrix is a powerful option scanner that can quickly isolate the most overpriced options premium. So what we do, we start with the Unisearch. And we talked about this in Module 4. Now, kind of don't pay attention to what I've got over here, the safe and sound options. I took this slide from a very, very old, before I had the Options Pro Advantage folder. So keep that in mind. Now all these scans that I use, these are all in that Options Pro Advantage folder. So don't try to look for this. It's not important. Starting with the Unisearch, we did a scan for safe and sound, okay? Once that scan is done, in my Unisearch, what we did in Module 4, I showed you how to just do a graph. We're going to click the Options Pro button on the Unisearch. It's right up here under your main Options toolbar. Inside of that, we've got a screen that pops up that says Launch Options Pro. Now, from that Launch Options Pro window, you can select Bull Put Spread if you want. There's also a selection up here that says Load Option Chain. You can use and launch Options Pro with any one of these up here. Do not press this, okay? Don't press Load Options Pro. Do it from up here, from one of the risk graphs or that little button that says Load Option Chain. Because if you do it from one of these buttons, it's going to bring inside of Options Pro that Unisearch list, okay? So we're going to bring inside Options Pro that list of stocks that came up in the Unisearch. Now from here, what I want to do is I want to start filtering these stocks down. I know they're all good bullish candidates from VectorVest. Now I need to start analyzing this from my options trade because these are good stocks, but not all stocks are good options trades. So I need to make sure it's a good options trade too. So step number one, I'm going to go to the lower right-hand corner where it says Send To, and I'm going to send this over to the matrix. If you click that little Send To button right there, it drops down. I'm going to send that list over to the matrix. Now what I'm going to do is I'm going to use the matrix to find overpriced options. There's two scans that I use for this. Now, if you've seen some of my Monday classes, and I'm sure that you guys probably have, you've probably seen me do a scan for stocks with overpriced options. There's also another one that I use, the CIB mean greater than HV45 above 2 standard deviations. I'll explain what that means. But these are what I use. So the way that you maximize, you run the matrix scan, you chart results, and you cherry pick the candidates. Now, what do I mean by chart results, cherry pick candidates? Run the matrix scan. We're looking for overpriced options. It's going to bring a list of stocks to the table. I then chart them. When I chart them, I'm looking for two things. I'm looking for, number one, what we talked about in Module 4, okay? I'm looking for those characteristics. I'm looking for really like right in a bullish market, upper left to lower right in a bearish market. And then the second thing I'm starting to look for now with my cherry picking, I'm going to take a look at that overpriced and underpriced indicator. I want to make sure that I'm at the right side of this trade on volatility. So let's show you how this works. Scan number one is stocks with overpriced options. So once I send that list over to the matrix, in the upper left-hand corner that says Apply DT Scan, okay, I drop this little arrow down. It's going to open up a menu. From that menu, there's a lot of different scans in the program, but I use this one primarily. I go down to where it says Advanced Scan, and then from Advanced Scan, I select stocks with overpriced options, okay? And you can even see implied volatility and historic volatility. Now, when I run that scan, what it's going to do, it's going to take this list of stocks that I brought in from the Unisearch, and it's now going to only show me things that if I were to open that graph up and show the over and underpriced indicator, it would only be stocks that are in that cyan color that are overpriced, all right? And you can kind of see the root here. What are we looking for? We are looking for IV to be greater than HV. And you can see it right here. The implied volatility is 68%. The historic volatility is 45%. The difference is 23%. The implied volatility is 23% higher than historic. On CTRP, the implied volatility is 51%. The historic is 31%. There is a 20% difference. So it ranks them in order. Now, what I start doing is I start doing my cherry picking. I can simply right-click on one of my symbols. It'll open up a little menu. I can choose chart. So right-click, choose chart. Now, what I can start doing is analyzing. Would I want to be long SCLN? I mean, the chart is moving from lower left to upper right. It did have a big dramatic sell-off that day. But if I start going back and looking at this, I notice that there is, you know, a little bit more room maybe on this thing. We're still a little bit low. Okay, we're still a little bit low on this thing. So it's overpriced, but it's lower than the kind of the historical highs or that little plateau area. All right. Again, it's a gut feel. All right. It's a gut feel. Now, we can look at it. Here's Southwest Airlines, love. Take a look in the back. And I know there's all these little things up here, but look at where the plateaus kind of come in. Here, here, here. Look at where it kind of came in right there and right there. Look at where love is right now. It's pretty much right near the highest historical levels of volatility. Now, if earnings were greater than 14 days away, this is a trade that I would take as long as it has the minimum risk reward that we're going to teach you in Module 6. This is the kind of trade that I would want to take. Does it go higher? Sure. It can kind of peak out there. But remember, here's the key. If it goes from 12 to, let's say, 15, that's okay. Even if it pops up from like 12% overpriced to 15, that's okay. I don't want it to be 1% overpriced and rise to 12. That's bad. All right? 2% rise in implied volatility is a lot better than like 12%. So you want to make sure you're near the highest areas. All right? And again, it's an artistic thing. All right? Now take a look at this one. Hawaiian Airlines has a better chance of volatility moving higher. Now, here's what I will tell you. This does depend on where the earnings announcement came in, okay? Earnings are coming in, and let's say earnings are right here. This is an earnings date. I would be very, very skeptical of taking a credit spread right here on Hawaiian Airlines, because if earnings are only 4 weeks away, what's that going to do? It's going to rise up. Now, what if earnings, and I will tell you this, what if this is the earnings date and we don't have earnings for another 3 months, 2 months? Would this be acceptable in that case? Sure. Because after the earnings announcement, what generally happens to volatility? It stays relatively stable or even drops considerably until that 3 to 5 week run. If this was an earnings announcement right here, and this was a couple of days or a week afterwards, I would have no problem doing a credit spread here. I would have no problem doing a credit spread here. Probably wouldn't even have a problem doing credit spreads anywhere in this area until you get that 3 to 5 weeks before and it starts rallying up there. That's where you've got to be careful of, okay? Remember, IV rises most in the 3 to 5 week range before an earnings announcement. So, you know, when I go back here and look at, you know, Hawaiian Airlines, if this has an earnings announcement coming here, that's not a good trade. But if this was the earnings announcement and earnings are not coming out until another 2 months, then yeah, this actually is a good place to take a trade. There's a little bit of interpretation you have to do here, okay? But I want to teach you the right way to be in the trades. Now, also, don't overlook stocks at the bottom of the matrix scan. A lot of people, they focus all their attention when that CIVM and HV is like 20, 30%. Some of these, like down here, like UHS, look at UHS. The last 3 times we had an earnings run, it really got no higher than 3%. So that's a smaller number, but for UHS, that's still a very, very overpriced option. Okay? It's still a very overpriced option. So don't overlook any of the stocks. They can still be near the top of the range. All right. Now, that is the scan that I primarily use for my trading. There's also another scan that we can use. It's called the CIV mean. And again, what's the CIV? CIV is cumulative implied volatility. And what we do is we add up all the volatilities, the calls and the puts, then we weight it based on strike price and expiration. It's a big average of volatility. And then is it greater than 45 above 2 standard deviations? Okay, that scan is basically right here. It's still under advanced scan, and you see it right there. CIV mean minus HV45 above 2 standard deviations. All right, I want you to think of this like what we've talked about in the past, 2 standard deviations. What's a standard deviation? Remember when we had a graph, the graph was going up, and then in Module 1 I showed you the probability envelope, okay? The probability envelope was 1 standard deviation, okay? That's where the data normally resides. If I see the data kind of going back and forth, that's the mean. That's what standard deviation means. It's the mean or the average distribution. If all of a sudden the stock rockets up like this, that means that we are operating outside the mean. It is a much, much, much bigger move, okay? Now, I want you to think of it this way. I want you to think of it in terms, and let me erase this. I want to think of it in terms of that over and underpriced indicator, right? I've got that over and underpriced indicator. This is where the thing comes in. These are underpriced options. These are overpriced, okay? If I'm watching that overpriced oscillator, it's rising and coming down and rising and coming down and rising. This is basically what this scan does. If you could imagine a probability envelope on your over and underpriced indicator, this is what it looks for. If options are trading in that mean range, they're a little bit overpriced, or maybe they're a little bit underpriced. But if all of a sudden options get extremely overpriced, okay, that's where this scan might pick up on the data. All right, that's where the scan might pick up on the data. All right, now there is a drawback to this scan, and I'll show you what that is. Okay, what happens if options, that line's not exactly perfect. Hang on a second. Let me try to redraw that. Not that I want to be perfect, but I want to try to get it at least moderately straight. What happens if options are underpriced for a while? Well, if they're underpriced and I draw my little one standard deviation envelope there, or in this case, standard deviations, well, if options kind of trade in that range and then go up like this, that's technically a 2 standard deviation move, but options are still underpriced. All right. Now, if you're not kind of getting what I mean by there, here's what I mean. The benefits of that scan are you get a higher likelihood of returning the most overpriced options. The drawback, of course, is it's more restrictive and results may not always be overpriced. Now, another drawback to this scan is quite a few of them may be very, very close to earnings. You're going to see these come in when earnings are close. So that's another drawback. Now, I want you to take a look at this, all right? If you look at this right here, I scanned for CIV mean minus HV45. Alta came up on the list, but Alta is still underpriced. That's because, again, if you can kind of imagine a 1 standard deviation or a 2 standard deviation envelope looking at this thing, it may have snapped up out of that, but because those options are so underpriced, it's just not ready yet. Okay, it's just not ready. So that's why you pick that up. Now in the mastery session on Friday, I'll actually show you, you can actually use this in conjunction with your overpriced scan, which means I can filter this list first by overpriced and then filter it again by this secondary scan. So there is a chance you'll get some underpriced options in this, but then you could also get ones like this, where, you know, options are reaching the peak level for the most part of being overpriced. All right. Now something on Michael Kors, if earnings are still 2 weeks away, well, guess what? I might be able to do something like that because, again, you got to put this in perspective, right? The peak, for the most part, is right around 25%. 18 to 25% is not as dramatic as like 0 to 18%. That's what I'm trying to avoid. I don't want to be in this stock and volatility goes up 20%. If it goes up 5% or 6%, I can live with that, but not 20%. And I sure as heck don't want to do it down here when volatility is 25% underpriced. And then the next thing I know, it's 25% overpriced. All right? Here's another example. This is Workday. I've actually traded quite a bit of Workday over the years. But look at this one. Workday really doesn't get much more than about 20% overpriced. If earnings are more than 14 days away, this is a win. I would really that trade. The matrix allows you to focus only on the stocks that are overpriced. So we don't have to worry about putting a trade together and then going back and saying, we still don't have overpriced options. It really reduces the time to find the trades. All right, that's what it's all about. So now that we've got the list broken down, we had a unisearch scan. I've filtered it down so far to overpriced. Now I'm going to start the fine tune. Okay, we want to take those overpriced options and filter them even more. Remember, we used this slide in Module 4 too, the whole concept of panning for gold. You put a bunch of stuff in a basket, you shake the basket, all the little particles fall out, and now you can see the gold chunks, right? Each filter that we do gets us closer and closer to the gold, okay? We want to find the best trade candidates. So if you can kind of picture that funnel, Vector Vest search is what starts. That's what finds us the stocks that are in the right direction. The matrix brings it down to overpriced. Now I'm going to filter it even more to get us to the strikes that we want. Now remember, quick review of what we talked about from modeling. Our goal, our business plan here is we want to sell overpriced options that have a probability of in the money less than 30% with an expiration 21 to 45 days. Okay, that is our goal. So we've got a large list of stocks. Now what I did in this particular scan, I brought over my list from VectorVest, all right, sent it to the matrix, and then I did my first scan. Stocks with overpriced options, all right? So now out of all of those lists that I brought over from VectorVest, this is now only stocks that are overpriced. I need to really filter this down even more. I don't want to waste time on looking at a graph of Albemarle Corporation, whatever that is, or Reynolds American, or LKQ, or Adobe. I don't even want to look at the stock if it doesn't have options that work for me. So what I'm going to do is I'm going to filter it even more. In the upper right-hand corner, I click on Save. That's going to save the updated list of overpriced options. Okay, just click Save. What that'll do is it will filter that scan list down to only the overpriced options. And again, I've got videos of walk through how to do this in Digital Chalk, so don't feel like I don't understand that. There's plenty of resources there to show you how to do this in the software. Now, what I do is I change my DT scan up here at the top. I drop that little menu down again. I choose all symbols, and I choose option symbols. What I'm going to do is I'm going to take the price candidates, and I'm going to now filter just the options, all right? When you put on option symbols, it's going to open up another tab here. You're going to see option filters. Just click on option filters, and then we can start filtering out even more. I'm going to look for puts that are out of the money. I want them, and again, volume is not a huge ordeal, okay? Volume is not a huge ordeal, but I like to scan for open interest. I like to make sure that I'm only going to bring in things that are 21 to 45 days to expiration, and I also like to make sure that my probability is less than 30%, all right? So what I do, once that's all in there, I click on Scan, all right? What happens? My matrix updates, and out of everything in that list, I only have one trade, Disney. So I brought this list down from maybe 30, 40 stocks only to one. And it tells you right here, the 100 and the $95 strikes have the right probability. They have the right open interest. This is the trade that you should put together. Okay? Now, I will tell you this. In Module 6, we'll also talk about minimum risk to reward as well. All right, so what we did there, We did the scan, the vector vest search, down to the matrix, down to the filter. Now you're sitting at the option roots. These are the graphs that you want to start looking at. You don't have to waste your time. So now that you have that, be selective. Key principle number 4 is to be selective with your trades. You know, a lot of traders feel the need to always be active, always be trading. And that causes a lot of people to place trades that they shouldn't. I saw this in February. You know, in February, a whole volatility thing going on in the market. I didn't do much. Be selective. They place trades that don't meet the checklist. Maybe they're close enough. You need to be selective. It's like, you know, what's this slide? Why do I have a little girl with picking a pumpkin? It's like when kids go pumpkin picking. They don't just go out and pick a pumpkin because it's the one that they see. They look at it. They analyze it. Well, this one's got a little flat spot. There's a brown spot on it. This is not the right one. They don't pick it because it's close. They're very, very selective. Trust me, I've been down this road. Okay? Nothing better than 3 hours in a pumpkin patch trying to find the exact perfect pumpkin. You know, what are you going to do, right? Remember, there's 4 types of trades that we teach, all right? There's bullish trades, there's bearish trades, there are neutral trades. Well, you might be thinking to yourself, Ron, we only talked about 3 trades. Let me introduce you to trade number 4. It's called no trade, okay? There's bullish, bearish, neutral, and none. If you go through all of the work and you pull up the matrix and this is what happens, it comes back and says there's nothing there, that is not necessarily bad, okay? That's not necessarily bad. Don't always think that you will find a trade. Now, what I will tell you is this. I only brought over 1 scan from VectorVest. If I do that and there's no trading, guess what? I can bring another scan over too. All right? So don't feel like it's always a bad thing. You might just want to go back and do, you know, yeah, I was safe and sound. Maybe do vector 1, 2, 5. This is not about trading simply for trading's sake. You want to make the right trades with the proper option market conditions. And if you can't find one, then take the 4th trade. Just don't trade. I am extremely selective of the trades that I have taken. So for those of you that have seen me do this live in my Monday class, you've seen me go through and say, I don't like that one. There's too much risk. I don't like this one. I don't like this one. Ooh, this one looks really good. You know, you've seen me kind of go through and parse that information down. If you can't find one, don't force yourself to place a trade. It's just not worth it, okay? Don't get wrapped up in our big mistake to avoid, which is simply, I'll just pick one because I need to trade something, all right? Don't be that trader. If there's nothing there that meets the criteria and that doesn't look good enough, there's no trade, okay? Now, I can tell you this. I've been doing live classes with Options Pro students now for 3 years, okay? I've been doing this a while. I can tell you this, all right? I have never not been able to find at least one trade, okay? So I don't want you thinking that there's going to be weeks and weeks and weeks of not being able to trade. I have never had a position where I've never been able to find something. There's 3,000 plus optionable stocks out there. You'll be able to find something, trust me. All right. So what did we talk about today? We talked a little bit more about volatility. We just want to make sure that it has a better chance of going down or staying stable than up. It's artistic. Start looking at the over and under price, get a feel. Realize, and we'll talk a little bit more about this again in the mastery class, remember that the big rise in volatility happens usually about 3 to 5 weeks before earnings. And listen, that can be dependent on the stock. Some stocks rise 3 weeks before earnings. Some stocks rise 5 weeks before earnings. Here's the cool part. You will know as soon as you look at the graph and as soon as you look at the over and under priced indicator. Okay? Then we want to use the matrix. Let the matrix do the work. Filter to overpriced options. There's 2 scans that you can use. The stocks with overpriced options, that's pretty much the one that I do. You can also use that CIV mean and HV45 scan. Once we have the list of overpriced, we're going to filter it down. I particularly use open interest, days to expiration, and prob ITM. Okay, those are the ones that I use. And then be selective. Only choose trades that are right. Now, here's what I will tell you. You're probably asking, and Jim and John and Brian are in the background. I'm sure they're answering this question. Ron, what do you mean by choose?
Hey, Ron, I think your mic went out again.
Yep, I know. It just takes me a second to reestablish it. You might be asking, what do I mean by trades that are right? We'll talk a little bit more about that in Module 6. When I say trades that are right, by the time you get to that point, I would hope that you already have the Module 4 stuff in hand. You've already looked at the graph. You know the graph is going up or going down, but be selective. So now we're going to start bringing into things risk to reward ratios, making sure that you're not risking too much, the credits are proper. When I say be selective, that goes into what we talked about in Module 4 about the graph, what we talked about in key principle number 1 with the volatility, and what we'll talk about in Module 6 with the minimum risk to reward ratio, okay? I want to give you guys a complete education on options, and that's what this stuff goes into. So it might seem like a little bit cumbersome at first, but the cool part is it's not that hard once you get the ideas down. The matrix will do a lot of the work. All right, so some action items. I want you to use both the Unisearch and Options Pro to find a stock that has the core principles that we discussed. I want you to find something with overpriced options, a better chance of flat to decreasing volatility, and I want you then, once you have a stock, now, right now, the market, I think, is still in a DEW down. I'd have to look, but honestly, I don't care, to be honest with you. Just find a stock. I don't care if it's bullish. I don't care if it's bearish. Don't worry about the market timing for right now. Just go into the Unisearch, run some bullish scans if you want, run some bearish, find a good graph, okay? And then analyze it down with the overprice with a better chance of flat to decreasing volatility. Then we use the matrix to bring that down even further. Okay, that's what I want you to do. I want you to go out there and practice using this information. Just finding stocks, finding the options, just using the tools to get us down to that, core candidate. Now, in Module 6, we're really going to put the cherry on top, if you will. Module 6 is next week. It's Tuesday at 4:30, just like this one is. And I'm going to bring you guys in with the trade management game plan. This really is probably the most important out of all of these, because if you master trade management right, even if you make some mistakes in what we've talked about in 4 and 5, as long as you follow the trade management game plan, the probability is stacked in your favor, so you'll probably win either way, as long as you do this right. So in Module 6, we'll give you the preparedness checklist, okay? Things to look for, credits, things like that, all of the preparedness that you need to do to take the trades. We're going to teach you some repair techniques. We're going to show you how to minimize losses, showing you the exit strategy, and I'm going to show you how in some cases you can turn losers into winners, and at worst case, a loser into a small loser. We'll also in Module 6 talk about, portfolio management, how do you choose trade size, that sort of thing. So we'll bring that into the equation too. Okay, so that's going to be in Module 6 next week. It's probably going to be a little bit longer than the hour that we spent tonight. Probably might go into that hour and 30-minute range again. But it's going to kind of give you the complete look at money management for the trades. So we'll see you guys in Module 6. Just a quick reminder, Digital Chalk, everything is posted. Now, once we get into this area of, the class, we're in Module 5 now. If you're missing in Digital Chalk the classes, make sure you go up to the top and click Next, because sometimes that's kind of taken off the first page. You got to go to the next page to get Module 5, 6, and 7. So that's one thing to look out for in Digital Chalk. All right, so let's do this. Let's kick off the Trade Setup Maximizer Q&A. I'll bring Brian in, and we will get cracking on any questions that you guys have.
Awesome. Hey, Rob.
Hey.
We had a comment from Edward right there at the end. He said, "Great session." So,
all right.
all right, and another comment from Thomas was like, it was very helpful when he was going to those Monday sessions to actually see that you were able to do multiple searches and pull all of the stocks from all of the searches over to Options Pro and then do analysis, because he was doing things like one search at a time. So it was, and we show that in the homework assignment on how to pull everything over before you do the Options Pro stuff. So he just said it was very helpful to see you do that in those Monday sessions.
And that's the cool part. Now, what I've been doing in the Monday session, now that you're up to Module 5, now it's starting to make more sense, I hope. I know when you come into that the first time, before, right after Module 1, you're like, oh my God, what did I get myself into? But now you're starting to see, how we do this on a normal basis. It's probably starting to make a little bit more sense.
Yeah, and it was interesting. Tim had just typed in, he's like, in the Unisearch, can we insert multiple groups, multiple searches, and then put them into Options Pro at one time? And then he just typed in, okay, you just answered it. And Edward was the gentleman who had said that this was a great session, and he just typed in, he said, I was thinking I was too old for this. So, all right, so let me get to some of the questions that I had promised everybody that I would get back to them on. Oh, in fact, actually, it looks like Edward was the first one. He asked a question back at 4:55 that I promised I'd get back to. He said, this is back when you were showing the volatility, the over-underpriced indicator and how it would rise towards earnings. Mm-hmm. Edward said, so options expirations right before announcements, like if you set your options expiration before the earnings announcement, he says, they'd be less problematic?
Good question. That's actually a great observation. It depends. And here's what it depends on. Does the options, or does the stock have weekly options? You may have seen me do this in the advanced, my Monday classes. It really depends. If you have a stock that doesn't have weekly options, and let's say I've got a April 17th earnings, the April monthly options will be the ones that rise. But, I guess maybe instead of looking at this, I'll look at like Google, okay? Google has earnings on 4/26, April 26th, all right? So it really depends. Let me see, April 2018 calendar. Give me 1 second. All right, so here, Google has earnings on April 26th. All right, I want you to think about this. Think about it this way. Weekly option, monthly option, weekly option on Google. Now, that's kind of an advanced question. I hope this makes sense to people. When a stock has no weekly options, then that implied volatility is going to all come in to the monthly April option, even though that, well, actually, I take that back. It'll go into like the May option. But if an option has weeklies, what you can ultimately do is trade around earnings. So for instance, let me erase these lines. Earnings on Google are April 26th. Now, right now on Google, if you look at the graph, options are still very, very much underpriced, right? And what's going to happen is about 5 weeks or so before the earnings announcement, it's going to start to go up. Now, all options are going to start to get overpriced, okay? But here's how this works. The April 6 options, they will not be as much overpriced. What's going to happen is all of the volatility is going to start to rise on the April 27th option, because that's where the earnings is. This will be overpriced. These ones will be overpriced. These ones will be overpriced, but this is where all of the volatility will be. So if I have, let's say that I want to place a trade on Google but I'm worried about, the volatility rising even more. As long as you don't trade the April 27th option, the 6th is okay, the 13th is okay, and the 20th is okay, because you're not going to see the rise of volatility on those options like you'll see on the 27th. I'll explain this a little bit more in detail in the mastery session on Friday, because when stocks have weekly options, there's some really cool stuff that you can do where you can just place a trade and trade around earnings. You'll still take advantage of overpriced situation and overpriced condition, but you can trade around the earnings. Now, I will say this. You're going to be out of the trade before the earnings announcement still either way, but you'll be able to choose an options expiration that's between 21 and 45 days, just like I told you. You're not going to get that big last-minute rise in volatility. I know that I probably shouldn't have gone in this far, but damn it, this is one of the things that I always do, Brian. You know this. I start getting excited, and then I start teaching 3 levels ahead. I'll talk more about this in the mastery session, but there are times when you can place a trade like right here when a stock has weekly options, and you will not get that big move in volatility that you will like you will on the weekly. I can buy a November or sell a November. I can sell the October weeklies, and they're not going to have the big, huge move in IV like that weekly option for that will have. I'll talk more about that in detail on Friday.
All right, next up we've got Aaron. Aaron says, how far back should I look for the volatility level to look for that upper boundary?
I like to go back to the last 4 earnings announcements. So 1, 2, 3, 4. Just go back to the last 4. That's pretty much all you need to do. No more than that.
All right. Now, you might have answered this when I was kind of looking away, let's say. Stephanie this is when you were showing IBM, and well, it's the same for Google. You know how it increases towards earnings and then drops off?
Yep.
Stephanie had made a comment back then saying, but after earnings, the stock was underpriced. Why would you do options then?
Well, you can certainly do options. You just wouldn't want to do a credit spread. When options are extremely underpriced, I mean, that's a good time to buy options. What I like to do is after the earnings announcement, you see how after the earnings announcement right here on Google came in, options were still overpriced. This is still a great opportunity to do a credit spread, really, except for when it goes underpriced. But anytime it's overpriced, really until about 5 weeks before the earnings announcement, this is good. Now, here's the earnings announcement. What happens if you would have done a credit spread maybe right here and take direction out of the equation? But if I would have sold a credit spread and IV dropped down here, that's great, because as IV drops, my options, which were overpriced, are starting to lose their value even more. Now, I wouldn't want to do a credit spread down here, but after earnings, if you sometimes have that window where you can do credit spreads, or even, in Google, we could have done one here, we could have done one here, really anytime it was overpriced. There's a lot of times a very nice window after the earnings announcement that you can still do the credit spreads.
And we didn't build that into the checklist. And somebody had asked that earlier. I believe last week you had said typically wait about a day or two. Probably, I think you said 2 days after earnings to kind of let things settle down.
Yeah, that's not a general, that's not an absolute rule. That's just one of those things that I kind of do as a, I wait a couple of days, because after, the market makes, big moves sometimes after earnings. So I like to at least wait until we get a lower low or a higher high, just to make sure that the market's going to keep moving in the direction that it did after earnings.
All right, next question is from Edward. Edward says, do you worry when IV is way over HV? And then he says, besides earnings, what else should I be looking out for?
On a stock, I really don't. Unless it's like a pharmaceutical stock, something like that, or a biotech. This is one of those, kind of a more specific question. I can't write every scenario into the rules or anything. If it's a biotech stock or something, or a pharmaceutical, you might have to look at something like an FDA earning or an FDA announcement coming out, maybe a trial's over, something like that. But ultimately, not really on a stock. Now, on something like the S&P 500, you might notice a huge spike in implied volatility around major news events. Elections. We had a huge move up when, London had their, exit, that Brexit vote. stuff like that, when, something like the SPY gets really out of whack, you can start kind of being skeptical. But, on a stock, unless it's like a pharmaceutical or a biotech or something, I don't really worry about it. I just make sure that we're far enough away from earnings.
All right. And it looks like maybe Michael is just a little confused. He says, can I use the over-underpriced option to determine volatility? And that's basically what we're using it for, right,
That's
Ron?
what it is. Yeah, and that's what that is. It's implied in historical volatility.
All right. Next up is some people were, and it's about earnings and the matrix.
Mm-hmm.
People were wondering, all right, so wouldn't it be great if the matrix, filtered for earnings, which it kind of does, but it doesn't.
Yeah, it really doesn't. I would just leave it at it doesn't and go to there. Yes, I agree with you. And let me tell you, that has been on like the top priority for software modification. So I'm with you and doing my best to hopefully at some point get an earnings. Like when I pull up a matrix and I do my scan for, overpriced, it'll come up there and say earnings date. I know there's like a little earnings check mark here, but that doesn't really do the trick. Yes, I would love for the matrix to do that, and I've requested that heavily.
All right. Eric, let's see. You say you used the same search that Ron did, but you got an entirely different list of stocks. Remember, we were showing some slides here for the most part of what we were doing. There in Digital Chalk, there's a video and there's a PDF that you can print out that gives you click-by-click directions on how to do it the right way if you were looking for trades today or tomorrow or whenever. I would go by that. Don't worry about whether your stocks right now are matching Ron's. Just follow those directions to a T. That's how I learned it. I just printed out that PDF, and it has pictures. It has numbers like do this first, do this second, and just match everything up, and you should be good to go. Jordan says, regarding trade timing, do you have to coordinate the DEW confirmation with the volatility?
No, those two are completely unrelated.
See, when you answer questions so fast, Ron, you give me zero time to prepare the next question.
Sorry.
All right, so Stephen, quick answer to your question. There is an Options Pro Advantage group coaching session Wednesday at 1:30 in the afternoon. Again, it's just like those Monday sessions, but those are run every other Wednesday. You guys are more than welcome to attend. But again, if you're still just trying to get a grasp of the paycheck content, you might just want to forget about it and just come to the Monday sessions the Tuesday sessions that we're doing here and the Friday mastery sessions, and just stick to those Tuesday, Friday schedule. Let's see. Why don't we do this? Because there's some I haven't read just yet, and they seem to be more. Some of them are a little bit more random questions that have come in. The key principles that were taught today. Let me just kind of scroll to that on my screen. The key principles were regarding making sure volatility has a better chance of going down than up. How about we do this? Let me just put a little flag on my screen. Are there any questions right now regarding the concept that Ron taught regarding volatility being more likely to go down than go up? All right, so Paul was saying, and this is kind of along those same lines, even though it involves the search. He said he was having trouble understanding the whole two standard deviation difference on that CIV, HIV thing. Can you explain that maybe again?
Sure. If you guys heard my phone in the background, I apologize for that. That was, I forgot to hit mute. All right, so here's what I mean by that. You got to think about it. If I put on a probability envelope on the graph, right? That right there is one standard deviation. Now, here's what I'll do. I'll actually remove that envelope, and I'll use the probability cone. And this right here is actually a two standard deviation envelope. All right, it doesn't matter. Just kind of visualize what one standard deviation. That's a two standard deviation data distribution for Google. Okay, that means that Google, as long as the stock stays in a relatively normal pattern, should stay in this range. Now, if it were to go beyond that, that's like really, really, really extended market behavior. All we're really doing is we're placing that same concept on this. So if I were to do on the over and under priced indicator, if I were to put that same kind of envelope on the over and under priced like this, as long as volatility, stayed in this, the normal data distribution, it would not come up in that scan. But if all of a sudden volatility were to go to like this and it broke that, that's where you get it. It's kind of operating at its extremes is what it's doing. Okay, so like this would be an extreme of volatility. This would be an extreme of volatility. And that's really what it's looking for. It's just looking for, the average data distribution might be here. This is the extreme. This is the extreme. Like I said, if you got to picture that indicator or that envelope on your over and under priced indicator. And I'll tell you what, let's just do this. And while I'm doing that, let's do this. Let me actually scan for that. Matrix, advanced scan, CAV minus H4 envelope. Take a look. Here's Watt. Okay, well, that's a bad example because see how extreme it was down here and see how violent the snapback was? Remember I told you how it can be, underpriced still? How about HK? This is what, you see how today it snapped up violently? It was like 50 and now it's 116% overpriced. It's finding those ones at the extreme. That's what it's all about. Like BW, Babcock and Wilcox, way overpriced.
You all done?
Yep.
When I do webinars with Todd, I'm like, Todd, you got to give me a sign that you're done talking. Like, say over. All right, Paul just typed in. He said, got it. So then,
all right, cool.
You good? All right, so I was answering Viswanath in the chat, and he said, "What's float?" I'm like, "We never use the term float." And then I was looking up in the upper corner of the screen where it says float.
Oh.
That just makes when you click on that, it makes a window free floating. You can move it outside the boundaries of the Options Pro software, which means if you got multiple monitors, you can drag that window to another monitor all by itself.
I was thinking how many shares were outstanding, but yeah, that's a float too.
And the group button, that just kind of groups, like Ron's got right now. He's got the group button highlighted in gold or yellow on both. So when he clicks on a stock on the right-hand side, it should change the graph on the left-hand side. All right. All right. So Stephanie is following directions. She was saying she had a question about the over-underpriced thing. Stephanie says, so when it's way overpriced, then you don't trade or you do trade?
Well, it depends. And that's the artistic side to this. It depends. You have to look like Babcock and Wilcox, right? This particular example. If I were to look, at the highest points, this is about, except for this big move right here, which is kind of strange. If you take that out of the equation, over the last, 2 years, the highest volatility has been is about 75%. If I see that coming in like right here on 710, and we're more than 14 days away from earnings, I would love to trade it here and here and here when it's very, very overpriced. So no, it's really about, yes, it can be overpriced, but it can't be, it can't have the potential to rise more. And the way that you say, well, how do I know if it can rise more? Look at the past. And even with this right here with Babcock and Wilcox with this big move up like this, honestly, after earnings, it's very strange for that to happen. That's abnormal. I don't take into account, oh, that's abnormal, so, I need to change my whole plan. No, that's an abnormal pattern right there after earnings. I would love, by the way, to, if I had a great trade on this one with all this overpriced option, I mean, it's never been that high before. So it's artistic. You got to look at the past. Has it gone higher in the past? If the answer is yes, it can still go higher, then no, you wouldn't want to trade it. But if you look at the past and notice that it's near the all-time highs and we're still 14 days and plus away from earnings, then by all means you want to trade it, because that's when the options are going to be the most expensive they're going to be.
All right. I didn't notice this one earlier, but this one was from Gordon. Oh, by the way, Stephanie just typed in thank you. Gordon this was back to that question where we were talking about choosing an option expiration date that happened either before the earnings announcement or after. Mm-hmm. And Gordon said, so do you mean that if you sell a weekly option before the earnings date that expires after the earnings date, that the volatility will not be affected on this option? Oh, go ahead. Sorry, I was going to say, should we just wait for a future, like a Monday session to talk about that? But it sounds like you're prepared and ready to answer it. Go ahead.
Yeah, I'm actually going to talk about that on Friday's mastery session too. I want to delve a little bit deeper into that. As long as, I don't have a problem going after an earnings date. It doesn't bother me at all. So, let's say a stock has earnings on 5/8. All right. Well, the May monthly expiration is after the earnings date. If the stock has weekly options, by all means, because I know that the biggest volatility spike is going to be on that week of March 8th. So yeah, I can trade March or May 20th, pardon me, without any problem. Because remember, you're going to be out of sorry, Brian, you're going to be out of the trade before the earnings announcement anyway. So whether the option expires after earnings or before earnings, it makes no difference. You're going to be out of the trade before then.
All right, a couple of SPX questions. For some reason, Kevin was saying that he didn't see something must be going wrong. What you're clicking on there, Kevin? Maybe just because I just clicked on chain and put the the caret SPX. Mm-hmm. And just like you, Kevin, said you did, and you should see open interest there, just like Ron's showing you on his screen right now. The other SPX question that I've got here is from Craig, and he says, all right, so if I'm only trading SPX, this lesson doesn't really help me, does it?
No, honestly, no. It really doesn't, because with the SPX, we pretty much don't take into account the over or under price. It really just comes down to a minimum credit. So yeah, honestly, if you're just trading the SPX, a lot of the stuff that you looked at today, it's not going to be that needed or vital.
All right. Let's see. All right, so going back to the core principles, are there any questions about the searches that Ron talked about? He showed two searches, I guess they're considered searches in the matrix. Are there any questions about the matrix, let's say, whether it be about the overpriced search, the CIV search, or using the option filter? So kind of open it up now. If you have questions about the matrix, now's the time to ask.
And we're going to do it live on Friday, by the way. We'll do a real-time scan for Friday's mastery session. We'll kind of walk through it.
Perfect. And somebody had, I think it was Tim, who had said, hey, in your examples, can you show real, live examples? And I said, that's what Friday's for. And Tim just typed in yes. It looks like he's got a question on that. John, the way that Ron gets a split screen is he goes up to the top where it says window, and he chooses tile vertical. And depending on how many windows he's got open, it'll vertically tile them for you. Charles wanted to know, can you save the option filters that he edits?
No, unfortunately you can't. I wish there was a way you could do that. That's another suggestion that I made into the software. But yeah, you really can't. I know there's like a little preset option filter over here, but no, it doesn't let you do it. I wish there was an easy way, because that would make everybody's life a lot easier.
Yeah, I think you just answered David's question as well. Let's see. So we've got how far, Richard says he just wanted to know how far back does CIV look?
CIV goes, well, it doesn't look back, it looks current. CIV is what the current implied volatility is. There's no history, if you will, when it shows you that number. Now, of course, you can go as far as the chart goes back. I can do the over and under price, not on the SPX, of course, but I can go back and I can look at how it performed historically. But when I look at today's bar, that's looking at today's implied volatility, today's cumulative implied volatility.
All right. And so one of the other things I just want to point out, a lot of, I see a question coming in about CIV. One of the things I'd advise everybody, not to do is don't get caught up in the weeds. Like I always tell people when they're learning technical analysis, like you don't have to memorize the formula of what all these things do to be successful. Like if you're looking at this, all you really need to know is that those blue bars are, up at the top and more likely to go down. You don't have to understand, how it's calculated, what CIV this and that means. Ron talks about it, but he also gives you the kind of the main things to look for. The chart should look like, and what those little bars at the bottom should do. Don't get caught up in what CIV to standard deviation means and how it's calculated and all that. So,
kind of goes back to Dr. D, our founder. You don't have to know how the engine works. You just need to know that it does work. Is that how he says it, Brian?
Yeah, let's see. He said, yeah, like you don't need to know how the engine works to drive the car. You just turn the key and know that it goes.
Yeah, I can never get his I've only been with 3 years, so I can never get him perfect. But that's the Dr. D uses a lot of the same ones that I've always used in my classes.
All right, and I see some people are asking about the matrix and stuff. How about this? That inside of Digital Chalk, watch the assignment video and go through the PDF, because that'll walk you all through and have you do an example for yourself. Get practice with that, and post questions on the Facebook group and bring your questions to Friday. And then Ron will go through it all again. He won't teach the class again, but he'll show you, go through an example with live data. Why don't we do that? That might be a good stopping point, Ron, just to say, let's kind of go out there, play with the stuff, and then bring your questions for Friday.
Yeah, I think that's fair, because it's, like I said, a lot of that will be kind of covered up, and I don't want to get into the mastery yet, but yeah, I think that's a good way to do it.
Okay. So I'll turn it over to you, Ron, so you can kind of wrap things up for the night.
All right, good deal. Thank you, Brian, as always. And like I said, this is the time to get out there. I'm going to be monitoring, of course, the Facebook site tomorrow and the Options Pro email. Get out there and give it a shot. Now, I will leave you guys with one tip, and this is probably going to save emails and calls. When you bring up the matrix, and when you're to the point where you're doing the actual scan for options, make sure when you're in option filters, this is a huge issue. Make sure that this on top is checked, okay? Because what ends up happening is people are like, all right, I want to do puts, I want to do out of the money, and I want to open interest 100, 21 to 45, and then I want to do prob ITM from 0 to 30. And if you're wondering, like, how do I get there? How do I get there? How do I get there? Watch the videos, okay? But I'm showing you a really quick tip. If you do all that stuff and click on scan, you're going to say, but Ron, this thing came up and it's 46%. Your matrix is junk. It's not. It's because you forgot to put a check mark right here. Now scan it and it picks it up right. So that's one real quick little tip for you guys as you're starting to work with this. Make sure that right there is checked, because you know what? I do this all the time too. Sometimes I forget to check this. So make sure that that's got a little check mark up there, because that makes a big deal. All right? So here's what we're going to do. We're going to break for today. We will see you guys all again on Friday for the mastery. We're going to do a lot of this real-time scanning, and I'll show you how to do this. We'll do some analyzation. We won't get to the point of any real trades yet because we don't have the proper money management techniques taught yet, but we're going to start really working this stuff to get you to the point of right trades. All right? Thanks again, Brian, John, and Jim. We'll see you guys all again on Friday, and we'll be standing by on Facebook and in the Options Pro or the Options Paycheck email, and we'll be glad to help you because we want you guys to implement this as quick as possible.